Welcome back, ladies and gentlemen. Thank you all for joining me today. I am very excited to go over something that I wasn't originally going to do a video on this at all. I was kind of thinking if there'd be like a good end of the year kind of learnings that I had. But then investing with Tom, I'll post a video or clip or whatever image here. Investing with Tom actually did a video recently talking on 5 things that he's learned from super investors for the year, and I saw that and I was like, I want to steal that because there's been some things that I've learned from people that he was talking about, and I figured it'd be a lot of fun to kind of share that. And obviously, I've been doing a lot more reading over the last year because you can see. Got the little bookshelf behind me. Obviously, this isn't all investing books alone. There's some other just random stories in there, but I wanted to show you, and actually, 2 of the things we're going to talk about are in these books. So we got One Up on Wall Street, and then we got The Education of a Value Investor by Spier. So obviously, One Up on Wall Street's Peter Lynch. But I figured that I really wanted to touch on this because I think it's important to kind of go over what you learned, what mistakes you made, and try to continue forward and not make those mistakes again, or bring those learnings with you forward into the new year and actually expand upon it and just refine it so that you're an even better investor. So let's dive right into it. Hope you're interested. If this is something you want to talk about or learn about, make sure to subscribe to the channel down below. Try to do value investor videos all the time and just touch on different things like this. So I'm very excited to share this with you. So number one thing that I wanted to go over, or I guess the first thing, is actually it comes from Seth Klarman's HBS interview that he did this year. Now, I did a video kind of summarizing this if you want to look at it, but really the important thing is that one of the things that I kind of learned, and I don't know if it's necessarily learned, but he kind of explained it in a way that just made the most sense to me, is the fact that markets are inefficient in certain areas, and things that cause this, and kind of what happens is due to the fact that investors run off emotion, and when emotions run high, people tend to do irrational things. So his example that he used was basically looking at a bond. You have a bond of let's say a AAA company. Let's say like an Apple or an Intel or some big blue chip company. All of a sudden something comes out, the company, for whatever reason, the bond raters decide to lower the rating of their bond. Well, now all of a sudden you have a bunch of investment funds and a bunch of other companies that all of a sudden can only hold AAA, and let's say it falls to A. Now they have to sell off these bonds. Suddenly the yield goes up, price goes down because of this sale, which creates an opportunity if you're looking at this company already. Because what happens is price goes down, you are like, oh, I think that this is the price it should be. The fundamentals of the company remain the same. Someone, for whatever reason, just decided to rate this lower this quarter or this month or whatever. Let's look into this further. And all of a sudden you see the inefficiency and you go ahead and buy and wait for it to go back to fair value to sell back. You have like this irrational moment where all of a sudden someone sells something off for not really a good reason, or because you're required to, or for whatever reason, like if they're trying to raise a new fund, they might get rid of an asset at a really discounted price just so that way they can get rid of it, get it off their balance sheet, close their current fund, and move on and go somewhere else, which doesn't make any sense to someone who's a long-term value investor, but it makes sense to someone who's just trying to get the next buck, get the next set of investors, get the next sort of, hot thing that they want to get into, which I took that to heart. So this whole entire year, I've really been looking more so for that, especially after he had that interview. When I heard it, I was like, okay, this clicks in my brain a lot more than some of the other things I've been listening to for whatever reason. Heard about inefficiencies, I've heard about all this other stuff, but man, that was a really good lesson that I learned, and summarizing that HBS interview really helped that. Now, the other thing that I learned was actually more towards the beginning of the year. It actually came from Jeremy Grantham's, one of his press releases or memos that he has, and I'm just going to read it to you here because I think that it's really important to understand. So, he said, the final feature of the Great Super Bubble has been a sustained narrowing of the market and unique underperformance of speculative stocks, many of which fall as blue chip market rises. This occurred in 1929, in 2000, and is occurring now. A plausible reason for this effect would be the experienced professionals who know that the market is dangerously overpriced, yet feel for commercial reasons they must keep dancing, prefer at least to dance off the cliff with safer stocks. This is why at the end of the great bubbles, it seems as if the confidence termites attack the most speculative and vulnerable first and work their ways up, sometimes quite slowly, to the blue chips. So this was a memo that he did towards the beginning of the year, talking about where we were at the beginning of 2022. Which obviously we've seen how a lot of what he has said is more or less played out in terms of we've seen companies fall, we've seen the S&P 500 fall, we've seen the QQQ fall, and really in general we've seen like a great softening from the time that he wrote this memo. Now, what I learned from this though is seeing how that works. How he talks about the termites go for the vulnerable stocks first, and then all of a sudden they work up to these considered blue chip companies. And it kind of goes back to the whole nifty 50 idea where you have these best companies in the United States, people just invest in them just to invest into them without actually doing any sort of research. And all of a sudden they don't perform. So overall though, what I've learned from Jeremy Grantham is it's important to understand what you are buying, when you are buying it, and what actually it is, because a lot of times these companies that are super speculative look really great. You know, you have the crypto of the world, you have the FTXs, you have all these crypto companies, like Voyager was a big one on YouTube for a while. And they seem fine in a great speculative bubble, but in reality, when everything in valuation starts to matter, when all these assets and things like that actually start to matter to people, all of a sudden these market makers and these hedge funds and things like that sell off their positions in a heartbeat because they go, oh wait, this is really overexposed or something like that, and you see prices basically crash. And what happens though is because these hedge funds have to compete with each other, they're competing for money, a lot of these Wall Street funds have to buy into these crazy speculative bubbles, and it's basically a game of musical chairs where you don't want to be without a chair when the music stops, but you're going to have to keep dancing in order to keep that money flowing in. And again, you've seen this with hedge funds, you've seen it with things like ARK. It's really not that surprising when it happens looking back on it, but I feel like in the moment, a lot of people don't recognize it as it's playing out, which when he wrote this, I really took a second look at what I was holding, and I decided to make some moves. And that's, if you've seen my recent portfolio video, or if you've seen the recent portfolio, that's what the net loss was for the year. So I really do think though that for me, reading that kind of like struck a chord with me, because I was like, okay, let me relook at all of my portfolio and see what I'm holding to understand it better. If I don't understand it, or if I don't think it's gonna hold up well in the economy we're going into, I need to sell off the position. And that's what I did, hence the loss that I had for the year. Now, the next one actually comes from Peter Lynch's book, and it's something I had highlighted, and it was something, it's funny because I read these books and I go through and kind of like fold or dog ear the pages that I have information on, and I'll go ahead and highlight what I find relevant and interesting. But this was the most interesting thing to me. And again, I've read a bunch of stuff this year, but these are just some of the items that I had read. But when he was talking about kind of the stock picker and why it's important and things that you need to check for. But he said, what I try to remind myself is that if prospects are so phenomenal, then this will be a fine investment next year and the year after that. Why not put off buying the stock until later when the company has established a record? Wait for the earnings. You can get 10 baggers in companies that have already proven themselves. When in doubt, tune in later. Often with exciting long shots, the pressure builds to buy IPOs or else you're too late. This rarely true, although there are some cases where the early buying surge brings fantastic profits in a single day. On October 4th, 1980, Genentech came public at $35. On the same afternoon, traded as high as $89 before backing off to $71. Magellan was allocated a small number of shares. You can always get shares in hot public offerings. I did better with Apple Computer, which I sold on the first day for a 20% gain because I was able to buy as many shares as I wanted. That was because the day before the offering, the Commonwealth of Massachusetts ruled that only sophisticated buyers could purchase Apple because the company was too speculative for the general public. I didn't buy Apple again until after it collapsed and became a turnaround. And really what this all amounts to, and what I learned from this was, and I read this more towards, I think it was more towards the beginning of the years when I read this, or I finished it definitely within the first quarter. And what happened was, in combination with that GMO memo from Jeremy Grantham and that book, I was looking at my portfolio, and that's kind of what I do. As I read through all these books that are back here, I'm looking at my portfolio, also looking at opportunities that are presenting themselves and deciding, is this worth it? And that book single-handedly probably saved me more money than any other thing that I have read this year, because it said to me, you have these opportunities through the IPOs. You have the Coinbases of the world, you have the Palantirs of the world, you have Tattooed Chef, or all these other companies that came public within the last couple of years. And it says, if this is really a good company, if this is really a good company and there's really opportunity here, there's going to be opportunity next year and the year after that, probably, if it's that good. If it's really growing that much and what you think and the optimism and just the hype and everything around it, if it's really that good, you can wait. And I had two positions, like I said. I had Tattooed Chef and Planet 13 in my portfolio at the beginning of the year. I read this book. I read it and I was like, okay, we're dumping it, because nothing made sense from the original thesis why I bought it. And again, this is part of the learning and why I want to kind of document all this stuff on my YouTube, is because it's all through this. It's, you read something, it strikes a chord, you go back, make adjustments as needed, if needed, or just file it in the filing cabinet in your brain and actually, pull it out every once in a while. But the IPO thing that he said here was one of the most important things that I did this year, and one of the most important things I took away from this book. So for me, I am so thankful for Peter Lynch on this one. And he saved me probably a lot more money in the future than I could probably ever quantify. So the next tip that I learned actually came from Guy Spier. And I honestly, watching Investing with Tom's podcast with Guy Spier is probably one of the most amazing things ever, because Guy has a lot of knowledge, a lot of wealth of knowledge to give. And I hope one day I get to meet him and maybe interview him, because that would be he's one of the most favorite people that I enjoy reading. I love listening to, because I think he has a good rational brain behind it. But from the education of a value investor, I just wanted to say this. So he's talking about really the rule, and this is on page 137 if you ever buy the book, but he says, if someone tries to sell you something, don't buy it. That's the kind of the name of the section. But he said, sometimes they are no doubt right. Logically, perhaps I should switch phone services or load up on their brilliant investment idea, but I just won't do it. I may miss out in the short term, but over a lifetime, I have no doubt that I'll benefit much more by detaching myself from people with a self-interest in getting me to buy stuff. This is a simple application of adverse selection. As Charlie Munger has joked, all I want to know is where I'm going to die, so I'll never go there. For me, if an investment is being sold, that's a place where I'll certainly want to avoid going. I even apply this rule if I'm at a cocktail party and someone starts telling me about a great stock they own or a private company in which they like to invest. I may listen, I may be impressed, I may even be tempted, but I won't buy if they would gain something from my doing so. In some cases, there might not be a sales commission or any other financial benefit. It might simply be that they derive psychological validation from successfully selling their idea. Either way, this is a no-go zone for me, because the provenance of this idea is wrong, since it stems from the seller's personal agenda. As usual, Buffett knew this long before I did. For example, he has a rule: never participate in an open outcry auction. Following his lead, I've never invested in an IPO and probably never will. When a company is going public, it has all the mind-warping sales power of Wall Street behind it. Of course, some IPOs catch the wind perfectly and soar, but the provenance is toxic, so it's safer for me to cross all IPOs off my buy list, even if it means I'm missing out on the occasional winner. The rule: if a seller has a self-interest in me buying, I ain't buying. So, and this is, again, Education of a Value Investor from Guy Spier. And really, for me, when I was reading that, this is the next book I think I read after the Peter Lynch book. And for me, it just kind of reinforced that idea of you don't need to buy into the hype. A lot of times, if you're looking at a company and there's a lot of hype around it, you don't need to buy it. And the perfect example for this last year for me, I mean, there's probably a multitude of examples, but one of the companies that I think is a perfect example of the last couple of years was Coinbase. Coinbase, I think, went all the way up to like $480, $450, somewhere around there at IPO. It IPO'd, I think, at like $400, $420, and it went all the way up to $450, which is absolutely insane if you really think about it, but it's at like $35, $40 today. So that goes to show you, the Wall Street has a self-interest in actually trying to sell this at the highest price possible, because they'll either get a little bit of shares or they'll get commissions based off the sales. So you got to ask yourself, who's benefiting from this? Why is there so much hype behind it? And, if there's this much FOMO, this much hype, what part of the cycle are we in? And that's really the lesson for today, is where are we in the cycle? And if there's this much hype around it, around a company that's really not doing that much, we should probably look in other places, which that's why I like that rule from Guy Spier, because don't buy in IPOs. It's not really worth the headache. And again, from Peter Lynch, if it's a good process and it's a good product today, it's going to be a good product tomorrow. And of course, last but not least is Warren Buffett is the last lesson person that I learned something from this year. It really comes from not only just his annual meeting this year, but just kind of the general way he's carried himself over the last year and a half. And really what I liked seeing was the fact that in 2020, in 2021, he sees the market ramping. You know what he did? He didn't do anything. He just continued his normal, all right, let's find undervalued companies, continue to buy if it's undervalued. And that was how he kind of approached the market. In this year, he did the exact same thing. He saw all of a sudden Ukraine war broke out. Occidental Petroleum was something that they had already had it. You know, they had shares, they sold the shares, they already knew about the company. As soon as that Ukraine, sort of war broke out and he realized that the oil and everything associated with oil, gas, and all the freight and everything that had happened, he decided to buy in and bought a massive stake into the company. And really, a lot of it has to do with the fact that in the lesson in all this is if you have the research prepared ahead of time, you can jump in and get into the positions that you need to, because he probably already had an idea of what the value is worth, what, upside, downside, what could happen. And then he also had some probably different theses that would play out on the bear and bull case. So if you have this aligned already and you're patient enough, all of a sudden the company drops into your buy range, you can load up on shares at a very cheap level because of the fact that you were prepared. And this is where that whole opportunity meets action kind of thing, in that he was very patient. They had, I think they had a convertible bond that ended up giving them some shares. They sold off the shares in Oxy, and then they completely bought back into it with, I think they're at 20% ownership stake of the company. So this is really all I wanted to go over today. I hope these lessons helped you. Thank you to Investing with Tom for inspiring this video and actually continue to make great videos. If you like his videos, make sure to click the link down below. This was the video I'm referring to. But if you like his videos, I've loved watching them. And also the Investing with Tom podcast has been great as well, because he brings on a lot of different investors. But if that's something you're interested in, go look in the description down below. Make sure to include his info down there. But with that being said, thank you all for joining me today. Hope you liked the video. Make sure to subscribe. Have a great day and happy investing.